Welcome back to the deep dive. We're pulling the most critical, surprising nuggets out of the source material so you can get informed fast. Today, we are strapping in for a high-speed, an expert journalistic report on the U.S. auto manufacturing sector. We're analyzing the top 3 listed players: Ford, General Motors, and naturally Tesla. Our mission: to analyze these 3 really quite different companies. You've got value, growth, and, well, the breakout story with GM. We'll use basic financial metrics, technical price action, and the latest news drivers. This is all as of the market close on October 21st. And we'll cap it off by running some fun paper money calculations just to see, how dramatically fortunes might have shifted over the last year.
Yeah, and it's important we set the stage properly for you. This sector is experiencing, well, massive divergence. It's really defined by extreme internal tension. You've got the legacy automakers grappling with the whole EV transition.
Right.
And then global macroeconomic factors like tariffs, supply chain stability, they inject just huge volatility. We're basically looking at data that reflects a battlefield, where companies are either fundamentally cheap or astronomically priced on future potential.
Okay, so a real mix.
Absolutely. And before we dive into any specific performance numbers or those hypothetical calculations, we just have to remind you, this analysis, it's purely for informational and educational purposes. It's based only on the data provided to us.
Important point.
Yeah, it doesn't constitute financial or investment advice. We're really just here to explore the data points and, what they might reveal.
Duly noted. Okay, let's start this deep dive then. Let's look at the company many investors think of for income, for stability. Ford Motor Company. Ticker F. Ford closed strong, actually. $12.56, up 4.75% on the day, puts its market cap just under $50 billion.
Right. And when you look at Ford, you are really looking at the classic value play in this sector. It's defined by dramatically low valuation metrics. I think the most striking number here is probably the price-to-sales ratio, the PS. It's sitting at just 0.27.
Wow, 0.27. That isn't just a number, right? It fundamentally means the market is structurally discounting Ford's enormous revenue. I mean, they've got $185.25 billion in sales volume.
Huge volume.
And the market's basically saying it only values every dollar of that Ford revenue. It's 27 cents. That suggests some serious long-term doubt about margin stability.
Exactly. But, there is a potential silver lining in that structural discount. The forward-looking metrics, they look a bit healthier. So while the current PE is 16.03,
Okay.
the forward PE is significantly lower. It's down at 9.24.
Wow.
That means analysts are anticipating a jump in future earnings, which, should make the stock look much cheaper next year if it plays out.
And for those income-focused investors you mentioned, Ford provides a pretty solid estimated dividend yield, 5.33%. That's a very significant return in today's market.
It is. Now, let's pivot, though, to the balance sheet. This explains some of that market skepticism we talked about. Ford's profit margin is, it's tight, 1.70%.
Okay.
And more critically, their debt-to-equity, the DE ratio, it's high, 3.56.
Yeah, that's quite leveraged.
It is. Think of that DE ratio like a highly leveraged homeowner. For every dollar of shareholder equity, the company has $3.56 in debt. And that leverage, it just makes Ford highly susceptible to changes in interest rates.
Makes sense. We also look at their liquidity. The quick ratio is 0.95.
It's just under 1.
Yeah. So a quick ratio below 1.0 is, well, it's common for big manufacturers, but it means if the supply chain seized up, Ford couldn't instantly pay all their short-term bills without converting inventory, which, can take time.
Definitely a factor. Okay, shifting to the technical analysis side. The stock is hot right now. It's up 7.81% just for the week. And a very healthy 30.16% over the last half year. So good momentum there.
Okay, so here's the key technical trigger we're watching. The current price, $12.56, it's only 1.87% below the 52-week high of $12.80.
Very close.
Yeah, that 52-week high is a major resistance test point. So a confirmed breakout above $12.80, that could signal a strong buy trigger for momentum investors. Momentum is high, but the relative strength index, the RSI, it's at 64.74.
Getting up there.
It suggests strong buying interest, yeah, but it is approaching that overbought threshold territory around 70.
Right. And the news context adds important color to this picture, doesn't it?
It does.
Reports confirm some near-term pain. Ford had to cut production for 5 key models, trucks, and SUVs.
Oh, okay. Why?
It was due to an aluminum supply disruption following a plant fire.
Ah,
So this news could impact their upcoming earnings, but interestingly, the market seems to be kind of taking it in stride.
yeah, the stock was up strongly.
Exactly. Maybe lifted partially by the, overall optimism from GM's stellar earnings release, which we'll get to.
Right. Okay. Let's look at that paper money scenario. We want to see the payoff for, say, betting on Ford when it looked cheap, when fear was high. Imagine you invested $5,000, hypothetically, when Ford hit its 52-week low of $8.44.
Okay, so that contrarian move, that would have purchased 592 shares for a total investment of $4,996.48, pretty much the $5,000.
All right. And holding those 592 shares until the current close of $12.56,
Yeah.
that means that small investment is now estimated to be worth $7,435.40.
So that's an estimated paper profit of $2,435.04.
Not bad at all.
No. A reward of nearly 48.7% for betting on this legacy automaker's recovery, even despite its high debt and those supply chain headwinds.
Okay, so if Ford is that structural value play defined by the low PS, now we jump to the polar opposite. Tesla, ticker TSLA. And this transition isn't just moving companies. It feels like moving from industrial operations to pure growth fantasy sometimes.
It really does. Tesla's market cap is colossal, $1.47 trillion, and that's despite closing down 1.08% on the day at $442.60. The valuation here is just, well, staggering. Tesla's PE ratio is 256.31, and its PS is 15.87. Now, compare that 15.87 PS to Ford's 0.27 we just talked about.
Huge difference.
It's an extreme difference. It means the market values every dollar of Tesla's revenue something like 45 times higher than Ford's. So this valuation clearly isn't based on today's results. It's all about exponential future growth.
Right. And the data does support some of that projected growth, right?
Yeah.
EPS next year is projected to grow by an impressive 40.65%.
Which is strong growth.
It is. But even with that high expected growth, we look at the PEG ratio, price earnings to growth, and it's still, well, stratospheric at 21.7.
Yeah. And for listeners less familiar with PEG, typically a ratio over 1.0 is considered expensive. It means the price might be higher than the growth rate justifies. Tesla's 21.7 is truly extreme.
So that confirms it. The
Yep.
stock isn't valued just on car sales. It's priced on a future where they deliver robotaxis, robotics.
Yeah.
Justifying that level of future expectation.
Exactly. Financially, however, Tesla's balance sheet is incredibly clean, which definitely helps support that valuation thesis. Their profit margin is 6.54%, significantly better than the legacy automakers like Ford. And they operate with minimal leverage. The quick ratio is strong at 1.55, and the debt-to-equity ratio is extremely low, just 0.17.
Right, so they're not dependent on external debt financing like Ford is.
Not nearly to the same extent. Now, technically, volatility is the core characteristic here. Tesla's beta is 2.07, meaning it's statistically twice as volatile as the broader market. Swings more, basically. The average true range, or ATR, is also high at 17.52, confirming, big daily price swings are normal.
Right.
Despite this, the long-term performance is incredible. It's up over 100% in the last year, and all the major moving averages, 20, 50, 200 day, they're all positive. Strong trend.
Got it. The stock is currently, 9.40% below its 52-week high? But that high volatility means it could close that gap fast or widen it.
Yeah.
So we might infer buy interest if it consolidates around this $442 level. But resistance will likely be fierce as it gets near that 488 volatile week high.
Yeah, definitely a key level to watch. And the immediate news focus is on their upcoming earnings. Investor reporting emphasizes that the focus is shifting almost entirely from short-term car sales figures to management's commentary on their robotaxi and robot potential. That's what the market wants to hear about.
But there are headwinds too, right?
Oh, absolutely. Headwinds remain strong. You see general reports of slowing EV demand overall and continuous analyst questions about whether this astronomical valuation can actually be sustained long-term.
Okay, let's look at the power of that volatility with our paper money test. $5,000 invested, hypothetically, at Tesla's 52-week low, which was $212.11.
Right. So that investment, it would have secured 23 shares, totaling $4,878.53. Again, close to the $5,000.
Okay, 23 shares. At today's close of $442.60, those 23 shares are now worth $10,180.
Wow. That's a staggering estimated paper profit of $5,301.47.
That's incredible.
a monstrous 108.67% gain. It perfectly illustrates exactly why investors are willing to tolerate that high valuation and that extreme volatility. The potential payoff has been huge.
All right. Finally, let's look at General Motors, GM, which had, well, a truly spectacular day, surging 14.86%.
Huge move.
To close at $66.62. This resulted in a $63.43 billion market cap. So it's actually cementing its position as the larger of the two legacy automakers we're reviewing today.
Yeah, bigger than Ford now based on market cap. And like Ford, GM is perceived as a deep value play. Its valuation metrics are pretty exceptional. PS is just 10.56. And the forward PE is even lower at 6.42.
Very low.
Extremely low. The PS is just 0.34. So again, the market values their sales revenue cheaply like Ford's. But interestingly, their core profitability seems stronger than Ford's right now. They boast a gross margin of 11.11%.
Okay.
And a profit margin of 3.48%.
So better margins than Ford. What about the balance sheet?
Financially, GM looks well capitalized. The quick ratio is healthy, 1.05. So they have good near-term liquidity, slightly better than Ford's, and their debt-to-equity ratio is 2.05. Now, that's still high.
It's still leveraged.
But it's significantly lower than Ford's DE of 3.56. So they carry less leverage risk.
Got it.
Now, technically, this is the story of the day, really. GM's one-day surge was massive, and the close at $66.62 is a definitive breakout. It's actually 7.21% above its previous 52-week high of $62.14.
Ah, so it broke through resistance.
Exactly. This move is significant. It's trading in new price discovery territory for the year. Blue sky breakout, some might call it.
Okay, that sounds like a definitive buy signal for momentum traders then, right? Breaking out like that.
Well, yes, but we have to inject a critical note of caution here. The relative strength index, the RSI, it's sitting at 74.57.
Oh, it's high.
That's deep into overbought territory. An RSI above 70 is the standard threshold. So while the massive uptrend is absolutely confirmed by the price action, that RSI reading often screams overheated, and it usually triggers some short-term profit taking.
So an immediate sell trigger warning, perhaps, for the very short term?
Potentially, yeah. Something to watch very closely if you're trading it. See if it can consolidate above that old high.
Okay. So what drove this massive jump?
It was all about Q3 earnings. GM beat expectations across the board. And critically, they raised their full-year guidance.
Ah, raised guidance. The market loves that.
They do. And they specifically cited an improved outlook on tariff exposure, which suggests they're successfully navigating those global trade complexities, and investors really loved hearing that.
Okay. But I heard there was some nuance in the news, too. Something about EVs.
Yes, and this is perhaps even more important contextually. Reports confirmed GM is strategically cutting production of its poor-selling BrightDrop electric vans.
Ah, cutting an EV product. Interesting.
Very interesting. This looks like a pragmatic margin-protecting move, and the market's powerful positive reaction. It suggests investors strongly favor protecting current profitability over simply chasing market share in every single EV segment, even if a product isn't working.
Fascinating signal from the market. Okay, let's measure the impact of that news event then. Our paper money calculation. Investing $5,000 just the day before earnings when the previous close was $58.
Okay, $5,000 at $58, that would have purchased 86 shares, totaling an investment of $4,988.
All right, 86 shares bought at $58. By the time the closing bell rang the next day at $66.62, those shares were worth $5,739.32.
So that's an estimated profit of $751.32.
Wow, in one day.
An astonishing 15.06% gain realized in a single trading day. It just demonstrates the immediate reward the market can give for successful operational shifts and, of course, positive earnings surprises with raised guidance. Hashtag tag outro. Okay, let's try and synthesize these findings a bit. You've got Tesla, offering extreme growth potential backed by that clean balance sheet. But its valuation demands near perfection in future tech delivery.
Right. High risk, high reward.
Then Ford. It offers stability, that nice dividend income, but it faces significant production headwinds right now and carries that high leverage risk.
The value play with bumps.
Exactly. And then GM is the recent breakout story, rewarding investors for focusing on optimizing their core business and, importantly, strategically pruning those underperforming EV projects.
Yeah. The valuation gap, though, it remains the central conflict of the sector, doesn't it?
Absolutely. Ford and GM are generating gigantic sales volumes, truly massive. But the market values every dollar of that revenue at less than 35 cents, basically. Their PS ratios are 0.27 and 0.34. While Tesla, by contrast, is valued, 45 times higher on sales? at 15.87 PS. That is the definition of the growth versus value chasm right there.
It really is stark.
So the key differentiating factor moving forward, it seems like it will be how effectively each company converts its massive sales into sustainable, durable profitability,
Right.
while navigating all the logistical and regulatory demands of the EV transition. And as we saw, GM took a very pragmatic step back from certain EV ventures specifically to protect those margins.
Right. So we'll leave you with this provocative thought then. Given GM's massive single-day gain driven by upbeat guidance and, significantly, the choice to cut poor-selling EV products, does the current market sentiment suggest that profitability today matters more to investors right now than ambitious, future-focused EV dominance?
Something to chew on as you continue your own deep dive.
Definitely something to think about. We'll catch you next time.